Good morning, everyone. I'm Layla Ballard-Shawley. Some of you might be sick of hearing me talking because you've heard me talk about Workiva a few times. But today we're going to go over capital assets. I was hoping this training would be shorter than the one I did last year. I think it still is shorter, but it did end up being a little longer than I thought it would be. But this training does build on and supplement that training from last year. So if you're completely new to capital assets, you may want to go on our website and look at the training from last year if you got the time. I'll show you real quick where that is. If you go to our website and go to guidance and forms for state agencies and click on GAAP reporting. And then you go to agencies that submit year-end reporting packages. We have a section called training materials. This used to be called sample reporting packages, but we changed it. And there's Workiva training at the top. But all the reporting package trainings that we've kept are in this section. So once this gets done and edited, it'll be up here along with the PowerPoint slides that I did. And the capital asset training from last year is on here with the slides. I think it was broken up. The first two parts were just the information from the slides, and the part 3 was going through the reporting package. On another note, related to Workiva, anyone in here has not submitted their GAAP reporting package, their second submission, because you are submitting it twice for FY25, please try to make sure you do that by Friday, because it is due on Friday. If you have any questions with that, you can call or email me after the training's done. We get started. Okay. First thing, I think there's some confusion with low value assets, partly because they're called low value assets and they're not actually assets at all from a financial reporting accounting standpoint. And they're not capital assets. Low value assets are fully expensed at the time of purchase, and they're not amortized or depreciated like capital assets are. The reason they exist is state policy requires some items to be tracked in SKIs as low value assets. I'll show you the next slide, kind of how that works. But I tweaked the flow chart that is our policy for this to make it clearer that building improvements, depreciable land improvements, and intangibles that fall below the threshold, you don't need to record them as low value assets. So this is, I'm sorry if it looks small. This is from our manual. It's just a flow chart to kind of help you decide what to do with an asset as you're determining if you should capitalize it, and if so, you know, what asset class you would use, etc. I added this thing with intangible assets because the chart never specifically addressed those. But again, if they're under the threshold, you can just expense those. You don't need to record them as low value assets. The other thing I tweaked a little is for the rest of the assets that have that $100,000 threshold, buildings, you would still record and track in SKIs as low value assets because they are something that's easy to track and really should be tracked. But building and depreciable land improvements, you're not required to do that. Now, I will say with depreciable land improvements, you kind of have a wide range of the types of things that fall in there. So it may still be good practice to put them in SKIs as low value assets and track them. You know, some examples would be like playground equipment or park benches or, you know, things that maybe you have a lot of maybe at several locations, then it's good to, still that make sure they're still there, they're still functioning, they haven't been damaged by weather or time or whatever. But again, that is still optional. And for all of the low value asset stuff, if you still wanted to, put it in skis as a low value asset for your own internal purposes, you can still do that. It's just the state policy no longer requires you to do it. I want to mention on the flip side of that, with capital assets, if you have something that falls below the threshold, you should not capitalize it. Like that's not an optional thing. And if I come across anything that's happened with, I may ask you to remove it from skis because it should have been capitalized. I'd also like to mention that if you do elect to put something in skis as low value asset that you weren't required to do so, once you do that, you are still required to track it and make sure you retire it when you no longer have it. So keep that in mind too. Another thing I think there's been some confusion about, and I'll go back to the last slide. It kind of asks if the asset is movable. And if it is, you end up using either the equipment, machinery, major asset classes, or a vehicle asset class. And if it's immovable, you generally are dealing with those $100,000 major asset classes. But I just want to clarify how these should be treated and kind of how to think about them. Again, like I said, movable equipment, because equipment's really the main thing that this gets tricky with, would be capitalized using a machinery equipment major asset class. There's several different, subclasses and skis you can choose from. And immovable equipment would be capitalized as either a building improvement, a leasehold improvement, or a depreciable land improvement. If the equipment is attached to a building and or would not continue to retain its usefulness without the presence of the building or structure, then you would do the building or leasehold improvement. And the distinction between those two is if you own the building or if you're leasing it. And if the equipment can retain its usefulness without a building, it would be a depreciable land improvement. So, as an example, you might have some equipment that's attached to the ground with a concrete slab, and that's more of an immovable type of piece of equipment that you'd have to treat, in this case, most likely as a depreciable land improvement. But what exactly do we consider immovable? If the asset is attached to the building or a building or to the ground in such a way that you cannot relocate it without the extensive use of tools and or the process of relocating the asset will result in damage to it. I should have put significant damage because I don't just mean minor cosmetic damage, something that would affect the functioning of the asset. Then most likely you need to consider that immovable. Capital assets, there's usually always some sort of exception, so I don't want to say that's the absolute rule, but that does generally apply to most things. So, if you have something that's attached with some bolts or screws, you just need to unscrew it. Maybe there's a little glue, but, taking it away from the wall or whatever, again, it does take some work to move it, but it's not difficult and doesn't create any damage to the asset other than something cosmetic. Those would not necessarily be considered immovable. You do have some cases where it can be kind of still more of a gray area. A lot of times I also tell agencies to ask themselves, if we relocated, would we take this item, or would we leave this item, or would we take it with us? And that often can help making that determination. So before I go to the next slide, does anyone have questions about those first few things? You can put it in the chat. Someone said, what about the aggregate values? But I'm not really sure what they're referring to. Any way you could clarify what you mean there? If anyone else has any questions? Okay, well, no response. I'll move on and we can come back to that if they clarify what they mean. Oh, okay. Items purchased in groups. If you purchase something in a group, now I am going to kind of get to, in a few minutes, a slide talking about how to determine what's a single asset. But there are cases where if you purchase something in a group and the total cost exceeds $1 million, this is something that was implemented actually last year, you would contact us and we would let you know how to handle that. In most cases, you're still going to treat the items individually and, you know, handle it, either capitalize them or expense them. We haven't run into any we've had to capitalize because they were collectively significant. But if you run anything like that, again, just call or email me and I can let you know how that should be handled. And please try to do it as soon as possible because we want to do it before you're actually capitalizing the items and not after the fact. Any other questions? Okay. So, yeah, this is the next slide. How do I determine what should be considered a single asset? This is something that can get very tricky and subjective. But some assets may be a system of various components. I don't know if that's what this question was referring to, or if you're just talking about a huge bulk purchase of, you know, 250 laptops that individually are way below the threshold, but may exceed it. For those, the laptop example, you would contact us. This is kind of a little different, I think, because this is something where you're purchasing a lot of things that they're being purchased separately, but you need them all to function together, or some of them to function together. So when you have something like this, the first question you want to ask is if the individual component can function independently without the other components. So as an example, let's say you purchase some audio-visual equipment, and that can vary in what you're exactly buying, but that could be TVs or monitors, cameras, microphones, speakers, control panels, whatever. Most of those, they're going to need the other components to have functionality. They're not really going to be able to do anything on their own. You would consider those collectively for capitalization. But you may have some items. The most common one is the television. That does have function and utility by itself. And you know, unless it's some weird, unique TV that they made it in such a way it can only work with the rest of your equipment. But most cases, it's just a normal Samsung or whatever you're buying with this. With those, you would consider the TVs separately. They'd either capitalize them as their own asset or expense them, do low value asset, whatever the outcome you need based on the threshold that's met. building on that, in addition to determining if the things can function independently or they need the others to function, you also have to kind of consider everything collectively by the same major asset class. So for this, everything I mentioned is equipment, so that doesn't really apply, but occasionally you'll get something where there might be some software included. So as an example, you buy a copier, it has software pre-installed. If your invoice for that purchase has a separate line item for the software, you need to consider that separately. So you would just have, you know, the software grouped together and determine how that needs to be handled separate from all the equipment. And if it met the threshold, you would capitalize it. You might have a situation where it's actually a subida, and you'd have to, you know, go through that differently. But in most cases, for stuff like that I've seen like this, you're paying for some software that's a couple $100, maybe a few $1,000s. It's pretty minimal cost. You're just going to end up expensing it. If you have a situation where maybe you are getting some software with the copier, but the cost isn't broken out, it's just kind of included with the cost of the copier. In that case, you wouldn't have to try to like assign a cost to the software and break it out. You can include it in that situation. It's only when you're paying a separate cost for the software. And on a side note, with a lot of these IT types of purchases, you may end up buying a lot of cables. And in most cases, the cable should be treated more as a supply type item and expense. And I mean, you know, things like USB cables or HDMI cables, these things that you probably have hundreds of at your agency. Those typically need to just be expense and not included in the cost of the asset. If it's a situation where you're installing a lot of cabling, you know, in a building in the walls, that's something you kind of have to look at as more of a building improvement asset. And again, that would be looked at separately. And maybe you have a situation where there's some really unique and or expensive cable that maybe should be capitalized, but the common everyday ones, please try to exclude those and just expense them. Make sure I didn't miss anything with this. Oh, one last thing. You also kind of have to consider the asset location. You shouldn't be grouping assets together if they're not located in the same place. Even this can get a little subjective if we're talking about within a building. But if it's something, you know, located in Columbia and the other things in Greenville, obviously those should not be capitalized together because you can't account for them properly if they're in two different places. If you're within a building, you might have to consider if it's something that's going through the entire building. Again, it might be more of a building improvement type asset, something kind of contained to a room and can function on its own in that room. Everything in that room is probably safe to be considered a single asset, but you know, it may be installed AV equipment in 3 separate rooms and they're all functioning independently from one another. But maybe you do them all in one invoice. In that situation, you would need to capitalize 3 assets for the 3 separate rooms. I'd like to add, software is getting particularly tricky, software and licenses. But you know, if it's software that you have a perpetual license for, you just outright own it, then that's when you're considering it for an intangible asset. If it's time limited, and a license, that may be a SBITA. Obviously, there's other qualifying characteristics for SBITA that I won't get into because I'm not the expert on all of that. But for some reason, if you get to that and you realize it's also not, it doesn't qualify as a SBITA, please keep in mind that in that situation, you might have to report a prepaid asset. And that's just because of the time limited component. You have a definite time frame that that license is going to be used over. You know, with most other assets that we tell you if it's below the threshold, you expense, the useful life is an estimate. So you wouldn't do a prepaid expense for those because you don't have a definite time frame. But for these licenses, you do. So try to keep in mind there might be 3 different outcomes you might end up having to choose between. So to sum this up, when you're determining if it should be considered a single asset, you got to determine if the asset can perform its primary function independently or requires other components in order to do so. So, you know, the TVs, most situations they can. A microphone just by itself really has no utility and needs to be capitalized with other items if you're purchasing them in a group with other items. 2, you need to determine what major asset classes each of the components you're purchasing should be classified as, and then determine capitalization by asset class as well as the individual assets. And you need to keep in mind where the asset is located as you determine the individual asset. This can get very subjective, as I already mentioned, so please feel free to reach out to me if you need any help, and always document your logic. Try to be consistent as possible, and you should be covered from an audit standpoint. Any questions about that? Okay, I got another question that I think was kind of related to the first one. How would you handle 100 identical desks that each cost over $2,500? Check. So that would not be anywhere near $1 million. So you would not need to do anything in that situation. But if you had a purchase like that that did cross $1 million or more, you would need to contact us and we would advise you on how to handle it. And that is, again, something very new from, I think, last fiscal year. But with all of those, agencies have to contact us. You cannot make that determination on your own. And there is a question on the capital assets reporting package about it. So if you, for some reason, did not contact us, you're still going to have to tell us about it at the end, and it will be more difficult to deal with if we do need you to capitalize it. So please try to contact us as soon as you're aware of it. Any other questions? Okay, we'll move on. Okay, okay. Lease and SBITA assets. I think a lot of people may not fully realize just because you have the lease and SBITA reporting packages and you know there's a liability and an asset, but part of this is the lease and SBITA assets are capital assets. So those do need to be considered and reported on through your capital assets reporting package if any adjustments need to be made to the asset portion. And if you're an agency that these are the only type of capital assets you have, you're still required to complete the capital asset reporting package. I think the master package the question has been revised to make it clear that that's required. With the lease assets, please make sure you're using an appropriate lease asset class when you create the asset in skis. I know implementation for this was probably rocky. I wasn't here when it happened. I was at the auditor's office still, but several assets were put in the system using a non-lease asset class, and I have to do a reconciliation and an entry every year to reclassify those. It takes a lot of time. Hopefully at some point we'll get some of them corrected, but some of them should just drop off and be retired. The big thing is going forward, please make sure you're not adding on to that, because it creates a lot of work that could result in some errors that we don't want to have. All the lease asset class sets and fees have the word lease in the description. There is also that leasehold improvement asset class. That's different. Don't use that one. For the rest of them, say something like lease building or lease copier. I don't remember them off the top of my head, but if you're unsure, you can always contact me or skis to make sure you're using the correct asset class. Just like your normal capital assets, please make sure you're retiring the skis assets and skis for any lease and submit assets that have been completed or terminated. So if it's no longer an active lease or submit for you, it needs to be retired in skis. You don't necessarily need a turn-in document for these because, it doesn't function the same way as your normal asset. You might be sending the surplus property or whatever, but it still has to be retired. The capitalization thresholds for these, they're a little different than the normal capital assets because land, I think land is always, you capitalize no matter what in either case, but buildings, just for lease assets, you capitalize those no matter what. It's not 100,000 like the other normal non-lease capital asset. Vehicles and equipment are still $5,000. But I just want to make sure that everyone understands that's per item. So if you have a lease for 150 copiers, you have to determine the capitalization per copier, not per lease. For any that do need to be capitalized, you have to assign an asset number to each individual copier. And those should be tracked and inventory the same way you would just copiers you own outright. Last thing I want to mention is you might also have leasehold improvements. It says lease in the description. These are not lease assets. These would be more things that you're paying for out of pocket in addition to your normal lease payments. And it's kind of a quasi ownership until the lease ends. Usually you got to get, permission to do this, but it would be a situation where you pay to do these improvements. They would qualify as building improvements under that normal definition, but it's for a building you lease. And if you have any questions about that, you can contact me. I can help you figure out how to capitalize those. Another side note, I think since GASB 96 was implemented for SBITAs, there has been a little bit of confusion, I think for some people, not everyone, that kind of just replaced all software, like all software became SBITAs. And I just want to reiterate that that's not true. You can still have software or licenses that you are developing or purchasing, and they will be yours Either you have a perpetual license or you just outright own the code for the software. And those are still intangible assets. So just because something doesn't qualify as a SBITA doesn't necessarily mean it wouldn't qualify as an intangible asset. The big thing with SBITAs, I mean, there's other things that have to apply for it to qualify as a SBITA, but one of the biggest things, it is time limited. You have a right to use the software for a defined period. Someone asked about a completed lease that we ended up buying. I think there's specific guidance on how to handle that in GASB 96. I might have to get back on you and talk with James to make sure I'm telling you everything appropriately. But I do know it kind of depends on if there was an option for that in the contract, or I don't know if they have specific guidance if you just decide to do that after the contract's completed. But I'll get back to you. I would think you would just capitalize it. Any other questions? Okay. Depreciation and amortization in skis. This is something that no one can really adjust at the agency level. You kind of have to make sure you have everything correctly inputted for the asset, and skis is just doing it on its own. I recently got skis to make active a transaction. It was something that already existed in SAP to allow us to post unplanned depreciation adjustments. So we now have the capability of adjusting the depreciation, but that has to be done by the skis team at the direction of our office. But to give you a little more background, skis calculates and posts depreciation and amortization monthly. It only calls it depreciation in the system. And regardless of what day of the month an asset is capitalized in skis, it's going to get a full month of depreciation expense for that month. So if it's capitalized on June 1st or June 30th, it's still going to get the full depreciation expense for June. So if you're in a situation where you create the asset in skis before or after the month in which the asset was actually placed in service, and honestly, it should be when it's ready and available to be placed in service. The depreciation in skis may be incorrect, and this can be further complicated if the situation you're in crosses different fiscal years, because you really want to make sure that it's as accurate as possible at 6/30 specifically. So if you have a situation like this, please contact me, because we might need to do an unplanned depreciation adjustment. But we might also need to adjust the depreciation start date in skis, which you would need to do at the direction of our office. Again, you shouldn't try to just do that on your own. But again, in either case, please contact me and we'll determine what needs to be done to correct it. This is a much bigger deal, like I said, if it is crossing different fiscal years, or if you're finding it, several months or even years after the fact. Anytime it crosses fiscal years, we might have to do a prior period adjustment. This is something, because it's an asset, we have to consider not just the current year, we have to consider the prior years. So another reason you'll have to contact us and we'll determine what needs to be done. Any questions about that? If anyone has a question that maybe is too hard to type, can raise your hand and I can unmute you. And some of them can be hard to explain. But I'll keep chugging along here. We're talking about this a little bit, but transactions you have that cross fiscal years. You have a capital asset that you place in service, or like I said, ready and available to be placed in service at the end of the fiscal year or near the end of the fiscal year, but you aren't able to pay for it until the following fiscal year. We still need to reflect that capital asset as being ours at the end of the fiscal year. So as an example, you buy a piece of equipment, you order it May 1st, you receive it and start using it June 1st, but you don't get the invoice to actually pay it until July 31st. Oh, okay. I think I have someone. I'm trying to unmute you, Samuel. Did it work? I unmuted you, but you might also have to unmute yourself. Samuel Lee. You had your hand raised.
There we go. All right, can you hear me?
Yes, I can.
Okay. So I was going to ask, how would you handle the amortization or payment schedule when one item's being removed from it, from the schedule after several payments have already been made, and then it's subsequently being replaced with another item, but that other item has a different price?
Are we talking about Elise or Sabita or?
Lease for Sabita.
If you have a situation like that, you need to contact James because he's probably going to have you revise your payment schedule.
Okay.
And you might have to do a few things and keys to retire or add value to the actual lease asset. But I think he generally tries to have agencies contact him to work through how to handle that, unless it's something you do all the time. Because
Okay.
the way that package functions, you're going to have to make sure everything fully reconciles anyway. So
Yeah.
trying to answer the lease and Sabita stuff as well as I can. I'm not totally ignorant of it, but I'm not quite an expert on it like James is. So I try to defer people on that, but I do have to make sure the asset part is right. So I kind of get him to fix it, and then I might work with you after the fact to correct anything in skis and adjust the amortization. I think there's probably some people in the training that I've done that with before.
Sounds good. Yeah, that was kind of a little wrinkle that was thrown our way recently. So
Which agency are you at?
I'm here at Do.
Do? Okay. Well, if you want, you can send me an email after the training if it's something that you haven't got fixed yet, and I can get with James and see what we need to do to help you get it fixed.
Okay, sure thing.
All right. Okay, I'm going to keep going. So I don't see any other questions. I might start over a little bit because I can't remember exactly where I stopped. I think I stopped at the example. So like I said, you couldn't pay it until July, but it was actually a capital asset in June. So, the way skis is set up makes it where this process is hard because you can't put the capital asset properly in skis before you actually pay it. So in this case, you would need to report adjustment on your reporting package so that we could show that you do have the capital asset as of 6/30. And you would report any depreciation that needs to be recorded along with that. And you would also have a payable. You'd be reporting on the accounts payable reporting package. For this reason, I realize it even says this in the manual, you should try as best as you can to prepare the accounts payable reporting package prior to the capital assets for reporting package. I think they're due the same day this year, but if you're able to, try to do that because it can help you identify potential capital asset adjustments that you need to report on the capital assets reporting package. And the example I gave is going to be probably the most common, but you could also have, if you have any assets under construction, you might have had additional work that was done in the prior year that you haven't paid yet, and we also need to adjust your AUC balance for that. Outside of that situation, could also have, you do your inventories, you're supposed to, and those might result in some adjustments that might impact prior fiscal years. Let's say you found an asset that was purchased 5 years ago, it was never added to skis, or on the flip side, you found one that was retired 5 years ago, it was never actually retired. It was physically retired, but never removed from skis. Even if you end up correcting this in skis prior to fiscal year end, if you have a situation like this where it's impacting prior fiscal years, please contact me and I'll let you know if that needs to be reported on the capital assets reporting package. Because we might, again, have to do a prior period adjustment for that. Or even if you have one that maybe you did buy it in that fiscal year, but you capitalized it a few months late or several months late, please still contact me because, again, we might need to do one of those unplanned depreciation adjustments and or have you report it on the package. Any questions about that? Okay. Last three things, these were things, policy revision and just some clarifications and reminders that I sent out beginning of this fiscal year. This policy was actually effective the end of FY24 or June 1st, 2024. But basically, I realized that the way we were defining substantially complete, and I don't even know if it was in every place, it was in some places, was just wrong. It's not in accordance with GAAP. I think prior it was saying if it was 90% complete to go ahead and move it. That's wrong. Please don't do that. Technically, to be in accordance with GAAP, assets under construction should be moved from the AUC asset class to their final asset class, whatever that is, a building or software or whatever, when the asset is ready and available for its intended use, which that is the point when every asset should be capitalized. But with a capital project or other projects, if this occurs before the project is fully complete, any remaining project expenditures for that project should be expensed and not added to the AUC or final value of the asset. To try to simplify this a little for some agencies, we did kind of come up with a little exception to get you out of it if it's an immaterial amount or an immaterial amount of time that's going to pass between when the assets should be capitalized and when the project's done. So if the asset is ready and available for its intended use, but the project's not yet complete, agencies may elect to wait until the project is 100% complete before moving the asset from AUC to the final asset class if both of the following are true. So one, the remaining project expenditures don't exceed 10% of the project total or 100,000, whichever is less. And the project will be completed in 3 months or less from the date the asset became ready and available for its intended use. Again, this is to allow for a little bit more convenience for you guys without resulting in the asset's historical costs getting significantly distorted, or the depreciation getting significantly distorted because you're capitalizing it way later than you should be. So as an example, you have a building you're constructing, and it reaches the point where it can be occupied, which for most buildings, that's going to be the point where their certificate of occupancy has been issued. But maybe some rooms in the building still need to be painted, or there's just other punch list items remaining. You haven't got everything checked off yet. At the point of when the certificate of occupancy was issued, that is technically when the building should be capitalized. But if you elect to use the option above and you're able to, then you can wait to do it after the project's 100% complete. So if the total budget for the building was $2 million, and the total costs remaining after the point at which it could be occupied are at $200,000, then you would not be able to use this option. You'd have to move the cost in AUC as of the date of occupancy to the final asset class, to the building. And then the remaining $200,000 would just be expense, because that remaining amount, even though it is 10% of the total project, it is greater than $100,000. Any questions about that? I know it's a little complicated. And if you don't even want to mess with it, you can just move it. Okay. Gonna move on to the next one. We just got 2 more slides left. We had a few reminders and clarifications I think people were confused about for capital projects, and you might have other types of projects that are AUC that maybe aren't necessarily labeled capital projects, like from an executive budget office perspective. So the first thing is, I believe it was last year, or maybe it was this year, they all roll together at this point. Executive budget office increased their threshold for capital projects from 100,000 to 250,000. And that just relates to their process and their approvals. That has nothing to do with the accounting, financial reporting side of things. For the accounting financial reporting side, the threshold for these things remains 100,000. So building improvements, leasehold improvements, depreciable land improvements, or software, still 100,000. If you have something that's typically a capital project, but is no longer meeting that threshold for EBO, but does meet our accounting threshold, you can get skis to set up an other project where you can still have an AUC for the cost and still make sure the accounting is proper. So it doesn't have to be an EBO project for you to actually create a project in skis. And I honestly, I don't even know if software ever went through EBO. Those might have always been other projects with skis. And honestly, you might have some situations where maybe you're not actually like building or constructing something. Maybe you're purchasing some things that you're kind of buying over a course of time, and you need them all to actually place the asset in service. Even in a situation like that, you might need to create another project to make sure you get them all capitalized at the same point and depreciating at the same time. Second clarification. Some capital projects are set up in a way where the project may cover work being done at multiple locations, multiple buildings, multiple sites. And this is done for many very good reasons. It can help with procurement and It just makes the approval process simpler. It obviously simplifies a lot of things, but if you set it up in that way, you still have to assess whether the project qualifies for capitalization for each location slash building and not the entire project. From an accounting standpoint, you still have to determine what your individual assets are and track those costs per asset. You would account for the cost per location building. You'd move the cost for each location building from AUC to the final asset class based on when it is supposed to be capitalized for that respective building. But that would depend on the stuff we just talked about in the prior slide. But you would not wait to capitalize everything all at one time for the entire project as one asset. That would be bad. Please do not do that. I think some agencies may have done that in a few cases, and if you have, you may want to contact me because we should correct that. And again, to add on to that, each of those separate assets or building locations, whatever, you would have a different asset number for each building location in skis. And that's the final asset class. I think you can just use one AUC asset for the entire project. Keys could tell you that for sure. But even if you're doing that, you're going to have a way of tracking the costs separately. So you may still want to create multiple or just have some kind of internal method for tracking the different assets. Sorry, I said other, but I think if you have software, I think those are actually called I projects. I don't know if they're also considered other projects, but software and in some cases SBITAs, those are I projects. And I think they do function and behave slightly differently from some other ones, but just keep that in mind. Last thing, I think some people thought that if they did anything that resembled a building improvement, as long as it met the threshold, they just capitalized it. And that is not correct. There are 3 other criteria for determining if a building repair, maintenance, improvement, renovation, whatever you want to call it, project should be capitalized. The first thing is it adds square footage or it adds a new feature, such as maybe installing an HVAC system or a sprinkler system to a building that didn't previously have one. So if you're just replacing HVAC or a sprinkler system, that may not need to be capitalized. In a lot of cases, it would not be capitalized. But if you had a building that didn't have it to begin with and you're putting it in, then that would need to be capitalized. If you prepare an existing building or room within the building for new use, maybe you or have a conference room that you decide to convert into a kitchen, you would capitalize that. Or if you have something that extends the useful life of the building, and I'll add that it really should be extending the useful life of the building significantly. Sometimes that can be really hard to determine because a lot of things are just going into a part of the building and don't really affect the entire building. But that is one of the criteria. So kind of adding on to that third one, which I think is the most subjective and complicated, and I'm hoping at some point we can further flesh out this policy and make it a little clearer. But we have a lot of buildings that they're very old, they're fully depreciated, they're very close, or they've already been depreciated 20 years. But for buildings that are newer or, kind of in the middle of their useful life, a lot of the projects you might be doing to them, even if they're substantial in cost, they're things that are still expected to be done throughout the normal course of a building's life cycle. In other words, the project preserves the building's useful life rather than extends it. So common examples of this are roof replacements, HVAC replacements, replacing bathroom fixtures, new flooring, water heater replacements, repainting, etc. Now, we kind of had to clarify that because we have all of these really old aging buildings, if a building is fully
Layla, we can't hear you.
at all,
Now we can.
how long have you not been able to hear me?
About 1 minute. Not
What was
1
the
minute,
last thing
about
I said?
30 seconds.
What was the last thing I said?
The fully depreciated or close to being fully depreciated, the last sentence you were talking about.
Okay, I'll start over that part. If you have a building that is fully depreciated or close to being fully depreciated, it might be acceptable to capitalize these types of projects. So really with any project, you should be figuring out what asset you're working on and looking at the age of the building and how many years remain in the useful life assigned to that building as you're determining if the project will extend the building's useful life. Logic is there that even if something that doesn't normally extend the useful life of a building, if it's fully depreciated, there's no longer any useful life to extend. And this still requires a little bit of judgment. I haven't, if a building's been fully depreciated, I haven't really been harping on anyone to not capitalize this or that. But if you have a situation where you're getting a new HVAC and you're just 10 years into the useful life of the building, I am going to tell you that should not be capitalized. Any questions with that, especially since some of you may not have heard all of that? Okay. I'll bring this back up at the end, but here is my contact information, email and my office phone that I never know. I have to look up every time someone asks me.